Investors, according to Bianco research, passively managed ETFs and mutual funds just surpassed 50% of all assets for the first time. And that is adding fresh fuel to the debate over active versus passive and what it means for the market. Just a few days ago, Greenlight Capital founder David Einhorn, one of the most successful hedge fund managers out there, said he views markets as fundamentally broken because, quote, passive investors have no opinion about value. Now, Elon Musk made similar comments recently in an X Spaces with ARK's Cathie Wood, saying, quote, the percentage of the market that is passive is simply too great at this point, and that, quote, passive investors are riding on the decisions of active investors. For more, let's bring in Bianco Research President and macro strategist Jim Bianco. Brief disclosure, Jim does manage the Bianco Research Fixed Income Total Return Index in partnership with Wisdom Tree. After that intro, I have no time for the interview. Jim, I'm kidding. Thanks for joining us. What does this milestone that you point out mean, if anything?
That money that is going in and out of the stock market is driven on, as David Einhorn said, a no decision basis. We either buy SPY, which is the S&P iShares, S&P 500 iShares, or IWM, which is the Russell 2000, or BND, which is the bond, a Bloomberg Aggregate Index. We either buy them or we sell them. And we don't discriminate about the individual companies. The stock market has been set up so that it is supposed to be an allocator of capital. It is supposed to give money to good ideas, take money away from bad ideas. But when we go too much passive, everybody gets money. If you mismanage your company, you get money. If you do a good job, you get money. Everybody loses money when outflows come, even if you manage your company correctly. And it does put kind of a dulled edge on capitalism and on the ability of companies to change and to evolve with the needs that they need to.
Yeah, well said. Hey, by the way, last night on a program, we had entrepreneur and business strategist Tony Robbins on the show last night. Listen to what he had to say, Jim, about interest rates.
I was just with Howard Marks, Ray Dalio, and Jeffrey Gundlach. They're all three talking about how they think interest rates are more here to stay. You know, the market said they're going to cut, They said, you know, Powell may cut one more time. He wants to be known for, you know, shutting down inflation. But they also don't think we're going to return. They think that these higher rates of inflation are what we're going to have to get used to.
So quoting some big names, higher for longer, do you agree?
I do agree. I think that we are in a new era that started in 2020. New does not mean worse, but it is an era of friction inflation that we're going to see elevated levels of inflation and stronger growth, and we're going to see higher interest rates. A lot of the argument about why the Fed should cut rates is this old saw that rates go up until something breaks. And we assume with the big rate rises that we've seen in the last 3 years that we've broken something. But the reality is when you've seen the payroll report, GDP, even the inflation report today, we haven't really broken anything. The market can handle higher rates for longer. It's Wall Street that doesn't like higher rates for longer. Wall Street needs lower carrying costs. And that's why they keep pushing this idea that interest rates should be coming down. But the economy's not showing any need that it needs lower rates.
Like the banks. Jim Bianco, really appreciate your time. Thank you very much. Very smart analysis as always.